Good afternoon, ladies and gentlemen. My name is Amin Musa. I'm a partner at the Kenyan law firm of Anjawala and Khanna. I head the energy and projects practice at ANK, and I also head the energy and infrastructure sector group for ALN. Last year, we had a similar session at the ALN conference, and it'd be interesting to touch base in terms of what we've seen happening in the last 12 months. And I have a very prestigious panel today who will tell us about their wonderful war stories in developing energy projects in sub-Saharan Africa. So I'm hoping that we will have a fabulous session today. Since the last conference in Dubai, I'm happy to announce that the Lake Turkana wind project, the 300 megawatt wind project, achieved financial close, which I think is a huge accomplishment and goes to show that projects of that size, of that complexity, can actually achieve financial close. From a Kenyan perspective, we've had a number of plants in the last 12 months that have been built and commissioned, supplying power. And I think we've seen that across the continent, projects achieving financial close, projects getting built, and I think more importantly, for the people over here, the audience who are trying to figure out where the opportunities are, we've seen governments issue very ambitious tender proposals for development of power plants across the continent, geothermal, coal, LNG. Projects are now getting more ambitious, governments are getting more ambitious. So in many respects, I think these are very positive times. Having said that, we still hear stories about crippling power shortages. Zambia is a case in point where I think they had a national day of prayer. I'm not sure how far that's going to go to help them. South Africa is facing their energy crisis. Commodity prices are collapsing, and the interesting issue is how are these going to affect projects going forward? Are renewable projects still attractive when you've got oil at $30 to $50 a barrel? And I think also very interesting to note is the Chinese economy over the last couple of months has taken a serious downturn. And the question is, what impact is that going to have on Chinese interest in infrastructure and energy projects in Africa? Are they going to pull back and focus on China? Or are they going to get even more ambitious as growth slows down in China? And I think these are some of the issues that we'd like to discuss, and thankfully I have a fabulous panel today. All of whom, like I said, will hopefully have wonderful war stories to tell us about the pain, but also the pleasures of developing projects in sub-Saharan Africa. And I'd actually like each of my panelists to spend a couple of minutes just telling them about themselves, who they represent, and what are they doing in Africa. Vahid?
Thank you. Good afternoon, everyone. My name is Vahid Fatuhi, and I'd like to thank Amin for having me participate on this panel and to share with you some of our war stories, as he said. Access Power is a developer, owner, and investor in renewable energy power assets in Africa. So we develop and invest in plants that we then own for the life of the project. And currently we have about 1,000 megawatts of solar and wind projects that we are developing across several markets in Africa, from Egypt all the way down to Zambia. And we share Amin's optimism of the outlook, as well as his concern with regards to the dire need and the challenges that face the power sector. Overall, I think we're bullish. We think that the pattern that we've seen in terms of the sophistication of the market, the adoption of structures such as power purchase agreements, standardized IPPs, that is now starting to trickle across several markets, the increasing role of the DFIs and IFIs, such as the IFC, FMO, Properco, enabling these countries to have the resources and the funds to adopt these structures is really very promising. And we ourselves expect to spend over the next 5 years about $1 billion worth of investments in solar and wind projects across Africa.
Thank you. Osman?
I work at Mubadala Infrastructure Partners, which is a traditional private equity firm focused on infrastructure, minority owned by Mubadala Development Company. Our first fund has focused on Middle East, North Africa, and Turkey, and our second fund, which we're in the process of raising, will expand our focus to Sub-Saharan Africa and South and Southeast Asia. And there's a story in that our LP group, which is from North America, Europe, and in Asia, institutional investors, they urged us to go into Sub-Saharan Africa. We undertook a detailed study with a top consulting firm to explore other regions, and between Southeast Asia, Eastern Europe, Central Asia, we excluded Latin America, and so Sub-Saharan Africa was the most promising for infrastructure investments, although difficult. So we are now beginning to look at investments in Africa, both west, east, and south, and we hope that to complete our first investment, or within the next 12 months. Thank you.
My name is Nicolas Bruinhoge. I'm Business Development Director at Elisio. I want to thank Amin also to be on this panel. I think for the war stories, that's probably the reason why I'm here. Our company actually originated from a partial takeover of the activities of Electrowinds. Electrowinds is, as Elisio, a Belgian independent power producer and used to be active in 12 countries. So we're still active in the same regions, but we're only active in 4 of those countries. So we're active in Western Europe, Eastern Europe, and Africa. We actually chose 4 countries, being Belgium, France, Serbia, and Kenya, because of some quite serious setbacks that we've known in other countries. So we think we know almost everything that can go wrong if you look at developing, constructing, and even operating renewable energy power plants globally. If you look at, for example, in Bulgaria, we had luckily a small plant, a wind power plant of 8 megawatts, 6 turbines, when suddenly, literally overnight, they decided to institute a kind of injection tariff. Now you have to know it was a feed-in tariff system where you obviously are quite confident that you're going to get the cash flow for 15 or 20 years, depending on the tenor of the feed-in. They suddenly slashed that with 30%. In South Africa also, for example, we had quite some success. We built the first commercial wind turbine there in Port Elizabeth. And then we actually competed in the first 2 rounds of the RFP, I think the official name is the IPP, the public procurement for renewable power. And there, what you saw initiated as an invitation to independent power producers as ourselves resulted basically in all the large utilities taking large stakes. So the essence of what we're trying to do is to find our role. I think you have the example of Axis. They're huge. They're developing. We're also developing about 1,000 megawatts. But there is a role globally for smaller IPPs with direct access to equity. Our equity comes from Belgian municipalities, so it's there. It's ready to invest. And we are really looking to invest in stable countries. And we think in sub-Saharan Africa, obviously I think South Africa is one, but Kenya is also certainly another. There are undoubtedly more, but those are the ones that we're trying to access for the moment.
Thank you. Francis?
Everybody. My name is Francis Njogu. I work with a company called Gulf Energy. This is an indigenous Kenyan company with some Middle East investors that has three verticals of business. There's an oil marketing arm of it, there is a power asset arm of it, and there is a project development arm of it. Just to give a bit of background, we have the first indigenously owned and operated power plant in Kenya that started, it's an 80 megawatt heavy fuel oil plant, which, as Amin was asking about the war stories, we also have a bit because we went through a very interesting process where government of Kenya was transitioning from issuing sovereign guarantees to finding a structure that was not going to be very onerous on its debt obligations. So we worked with Amin and a few others to develop an IDA mega partial risk guarantee backstopped by a government of Kenya letter of support. We learned a lot from that. But we were very bullish about Kenya as a country because after that we jumped in and we are developing probably what is the most ambitious and biggest private sector investment in the region. It's a 1,050 megawatt coal plant, which is an anchor to the LAPSET corridor initiative, which is basically a port and integrated facility that's supposed to link Kenya with Ethiopia and South Sudan and other regional countries. We are learning a lot, but also we are very confident because we have a good understanding of the local market. It's not risk-free, as in any other place, but it's a risk that we understand and we want to solve and deliver affordable power to the people of Kenya. This project the core project is in partnership with also probably one of the leading investment companies in Kenya and in the region. And we think together we are going to be able to bring this project to fruition. Thank you.
Thank you, Francis, for that. Vahid, we will start off with you. You've just heard from Francis about 1,000 megawatts of a coal project. We have wind projects, geothermal projects, and obviously tariff is a sensitive issue in sub-Saharan Africa. Where do you see the role and the opportunities for solar projects in sub-Saharan Africa?
So myself, I'm biased towards solar. I think solar is great. I used to work in oil and gas. I worked for a company called BP, and I was heading trading of oil, big cargoes. Then I had a few kids, and I started developing a conscience. I was like, what am I doing? You can be part of the solution or part of the problem. I was part of the problem. So I jumped into solar. And indeed, solar is beautiful, it's sexy, it's great, but it has its challenges. And indeed, one of them has been the cost of implementation. When I started in the business, it would cost $5 million to install a single megawatt of PV into the ground. And you can imagine the challenges I had with my solar company to make it work. In fact, my company went bankrupt and I lost my job. But I stuck with it because I saw the future. And along the way, solar prices kept going down and down and down. And that same plant that would have costed me $5 million to build, today cost me just $1 million to build. So we're talking about a 5 times drop in the price of the technology. This is far better than coal, far better than wind, far better than thermal. So it's come a long way. And today, solar is attractive for a number of reasons. Namely, the fact that it can be deployed rapidly. And Amin mentioned Zambia and the prayers they're making there for electricity, which is a very interesting concept. I want to tweet that later, actually. I think that's brilliant. But look, to build a thermal plant, it's going to take you years, 2 years to build a thermal plant. They're having 8-hour power outages and load shedding of 8 hours. You can imagine how destructive that is to your economy and to your GDP. However, if you go into solar, you could build 50 megawatt solar plant in 6 months and start creating electricity, start energizing your economy far faster than you could for wind, for thermal, or for coal, which take 2 years plus to build. And at the same time, the levelized cost of electricity now in many of these markets is approaching very low teens, and within the next few years will be in the single digits, meaning 9, 10 cents kilowatt hour. And in fact, in South Africa, the cost of electricity from solar is now about 8 cents per kilowatt hour, thanks to the great work that they've done there. And I'm confident that other markets, be it Kenya, Zambia, Nigeria, if they go down this path and they keep hope in solar, they too will have not only reliable, low cost, but also environmentally friendly solar power in their economies.
Thank you, Vahid. Osman, you are setting up a second fund which will target projects in sub-Saharan Africa. I understand you're looking at setting up an office in Johannesburg. Can you take us through the thought process of your organization when they went through the decision of where do we go next and why was it sub-Saharan Africa?
We are opening an office in Johannesburg. We've done the thinking already, and so we're. So why sub-Saharan Africa? Very simply, we are a funnel for capital, right? So we have LPs who give us money, and then they make us responsible for deploying it in the best way possible in terms of returns and the appropriate risk-return profile, and the risk-return profile for Africa is very, very favorable right now. And countries are stable. They are implementing, particularly we're talking about energy. We invest in all of infrastructure, but let's talk about power and energy right now. So they have a IPP. A lot of countries have IPP programs. Kenya is an example. Zambia, various other places. And South Africa, of course. So the returns that we can get, maybe not in South Africa anymore, but the returns you can get for the risk that you're taking is more attractive than some of the other countries that we can look at, and that's really what's driving us. I mean, we're purely capitalistic. We're not altruistic in any way whatsoever, and so we will chase the best return for the risk.
Thank you. Nicholas, you've now, I think, become a warrior in Kenya, developing a 100-megawatt wind project in Peketoni in Lamu. Can you tell us about your experience in doing this, and how does it compare with developing a project in Belgium or France? What are the challenges and opportunities you see? Because you have quite an interesting mix of countries. It's primarily Europe, Eastern and Western Europe, and then suddenly a wind project in Peketoni in Lamu. What's been your experience, and what are the challenges you're facing in getting this project done?
That's actually quite an interesting question, because I think that you will be surprised by my answer. what I see over and over again in every different country is basically that, and I think that counts for all of renewable power, is that the risks that you encounter are quasi-identical all over the world. So whether Western Europe, Eastern Europe, or even Africa, the main risk and the main issue you encounter is the bankability of your off-taker. We are in Mpeketoni in a challenging environment, let's say, because we are not that far from Somalia, but as let's say the person responsible for the development of that project, I don't actually think that's the largest risk we encounter. I think when someone who doesn't know the country basically and who doesn't know the project will say, oh, it's very dangerous. But I don't actually perceive it as the major risk. I think the major risks in renewable power is the regulatory risk. For the moment, and I think Vahid has given a very good example with solar, which obviously needed very expensive, from a government point of view, support mechanisms a few years ago. That has dramatically gone down. Wind as a technology has also, the cost has also come down, I think, in South Africa, and the RFPs rounds there are really showing the potential of renewable technology. The price for wind has gone under $6 cents with let's say the least expensive of the projects that was chosen. But it's really regulatory risk. A wind farm, a solar farm, it is not the most complicated of technologies. It doesn't need the most maintenance. It actually creates quite a lot of jobs, to the contrary of what many people think. But it is not that complex, and it has no fuel cost. So as long as an investor, as long as the regulatory framework is stable and you can bank on it, literally, then you can invest. And we've seen in Europe regulatory frameworks going all over the place, and it's the same in Kenya and in Serbia. So I think the real risks, the true risks that you encounter as a developer are very similar in different parts of the world.
Thank you. Francis, after having commissioned an 80 megawatt HFO plant, you clearly decided to take it to the next level with a 1,000 megawatt coal project. Can you give us a sense of the scale of the project in terms of project costs, and how are you going to finance a project of this size? I mean, we have in the audience, the founder of the Lake Turkana wind project, Carlo. And when Carlo came to see me many years ago about the wind project, I said, where are we going to get 800 million euros from to fund this project? And I guess I'm putting the same question to you, is, where do you see the money coming from to fund this very ambitious project?
Yes, indeed, this is a very ambitious project, and we have a lot of respect for Carlo because he sort of opened the way for everybody. But development requires a lot of patience. As for any developer, this is not a fly-by-night business. You have to keep solving problems every day, and one day the problems all go away. Our experience is that the challenges are the same, irrespective of the size of the project. You have to negotiate a PPA, you have to negotiate the other project documents, and you get much more respect and listening the bigger the project is, because it starts to answer the key needs for a country that has the kind of shortages that you find not just in Kenya but in the region. Because with if you look at it from the regulatory side, from the off-taker's side, or from the government, by procuring a project like this, and if it's successful, then it answers a need. And instead of spending a lot of time working on very tiny projects that some of them may not succeed or that will take the same amount of time, it's easier to focus the efforts around one project of scale and solve the problem. Having said that, funding is important, it's a challenge, but funding follows a well-structured project and a project that is going to answer a need. Looking at Kenya, we have installed capacity that works out to roughly 50 watts per capita. If you look at what is baseload out of that capacity, it's actually less than 60%. When you compare that with other markets that the country has ambitions to meet, countries like South Africa, where you have installed capacity of roughly 1 kilowatt per capita, and most of it is baseload, then you realize that there's a long way to go. So in developing a project, then I see it like one of the most important things is to ask, are you coming to answer a particular need, or it's a nice to have project that we're trying to develop? In this case, our project is actually coming to answer a need. And therefore, it will be able to attract not just equity, it will be able to attract debt because it's coming to play a role in the development of the country. It's a big project, but I think transformational projects are meant to be like that. So we have debt lined up. We are in the final stages. We have actually signed most of the project agreements. We are closing the project. Is it going to answer a need? It's probably going to be the least cost producer in the country. And we've modeled a few scenarios to see, even with the movement of coal prices, I think commodities nobody can call where they're going to be, but the long-term direction looks like coal is going to be not rising too much by way of cost. Therefore, we think that it will play a very critical role in the energy needs for Kenya. Thank you.
Thank you for that, Francis. The next question I actually want to run across is, if you could tell me what is the single biggest challenge you're facing in developing your projects and what you think governments in sub-Saharan Africa, if you could point to one initiative you believe if governments in sub-Saharan Africa could adopt or put in place, it would make life a lot easier and take away some of the pain that we all have to go through to get projects to financial close and to commercial operation. What would that single initiative, government initiative, Wahid, be that you'd love to see governments in sub-Saharan Africa adopt?
In my opinion, the single most important variable that the governments can fix is putting in place a sound framework. And by framework, I mean the regulations governing a certain sector, whether it's solar or wind. Many times when we go into countries, we see that the regulatory regime is fragmented or completely, like a Swiss cheese, full of holes, and it's unbankable. And what that means is that it raises the risks profile, which subsequently raises the cost of financing. And we see that everywhere. We see that in Egypt, we see that in Benin, we see that in several other markets that we're active in. How could they mitigate that? Well, it's not very complicated, and others have done it. And there are IFIs such as the German government through KfW that come in and they support African governments working in partnership to put in place a framework with which the host government can then put in place tenders and procure electricity. And for example, in this case, they partnered, the German government with KfW, partnered with the government of Uganda and put in place what was called Get Fit, which is essentially a regulatory framework that creates all the project documents and the licensing regime for investors to go and bid competitively on a project of certain size and a certain technology. And they've done that now 3 times. And many developers and investors have actually gone into Uganda, to participate because of this appealing structure. We ourselves are now building the largest solar plant in East Africa thanks to this program. And so hopefully other governments will adopt similar programs, whether it's Get Fit or Scaling Solar from IFC, which will facilitate investors coming in, having confidence, lowering their risk profile, which then lowers the cost of financing and provides the governments with lower cost electricity.
Osman, what would you like to see governments doing, one single initiative that could hopefully change how we develop power projects?
Well, I'll give you a very naive view, which is that there's a lot of equity ready to deploy into sub-Saharan Africa in the energy sector. The really difficult part, as probably everyone in this room realizes, is getting the debt in place and project finance, non-recourse debt in place. And that, in order to get that, generally the ideal way is to for the governments to provide sovereign guarantees. And again, looking at it, we haven't spent an enormous amount of time in Africa, but what all the case studies that I've seen is ultimately the governments get there, but they resist for years, which only increases the cost of the project. And if they'd only ever understand that unless the country has creditworthy distribution companies and local banks that can provide long-term debt, until at least those two things are in place, they will have to provide sovereign guarantees or something similar to that in order to get even the DFIs interested in lending. So one thing I would want is, for the governments in the region who don't have the distribution companies and banking sectors that are healthy, just provide the sovereign cover quickly and not waste years and years and years resisting it, so that these projects can get built quickly, and then they can stimulate the economy, which will then help the banking sector and the distribution companies, etc.
Nicholas?
Actually, I think that my point is the same as Osman, but I'd like to put it differently. At the end of the day, an energy project, whether coal, wind, solar, whatever type of energy, you make money by selling the energy. And the main problem there is the bankability of the off-taker. And that is why you need a sovereign guarantee, because often, not only in sub-Saharan Africa again, the off-taker is just not bankable. The off-taker's balance sheet is not big enough for you as an energy generator to be certain that he will be able to pay, because it's a long-term PPA. We're talking 15, 20 years, for him to be able to pay you for that amount of time. So I think that's the main thing to do, is make sure you have a strong off-taker. Most of them, if not all of them in sub-Saharan Africa, are government-owned. You have to support them. If you support them, that they are able to credibly convince IFIs and DFIs and investors that they will be able to buy that power for a long period of time, then most of the problems, let's say not most, but that, for me, that's the main issue. What we've seen in other countries in Eastern Europe, for example, is that even a strong payment track record, or having the funds that are used for the feed-in tariff or another tariff being put on a separate account, can be enough, even if the balance sheet is not strong enough of the off-taker. Commercial banks, and that's quite significant for me, that commercial banks have or sometimes show more risk appetite than DFIs. They've told us, this off-taker, he's okay. Why? Because the money is on a separate account. It's being charged separately to the customers, and they have a strong payment track record. So if you can sell your energy, the essence of your project, in my view, is solved.
Francis, what can the government of Kenya do to get Amu Power to the finishing line?
I would say something to do with the regulatory framework. And I think that is a fairly general statement because you see, what is written on paper is always very good. But then, unfortunately, many times you find as soon as, let's say, a PPA is executed, the developer is left with the community to solve a lot of problems. So you may have a nicely written piece of paper, whether it is the PPA or whether it is a government letter of support as it is in Kenya or anything like that. But trying to manage the risk is where you start to have challenges for most developers. You're seeing land-related risks in Kenya, which call for a lot of active management of the process, because frankly, a government letter of support or a sovereign guarantee is a nuclear button. It's not the kind of thing that you can keep pressing all the time. So if there is a very clear framework that has a method or a way of the communities benefiting from the project, which is a call for really the developer and also government to have that long-term view that projects are going to be successful only when the communities where the projects are being executed are beneficiaries and there's alignment, then that gets spelled out to an investor as the investor is coming in, and there's a very clear mechanism. You know that this is what you need to have in place, and then you work with the community. So it's a blend between the regulatory framework and initiative by the developers really to make the projects very successful. I think that's one of the things that I think is a big risk. Governments have a lot to play there, but also developers have to do their part.
Thank you for that. I think in the past we have seen, in relation to financing of projects, money primarily coming from development financial institutions, whether it's debt, whether it's equity or mezzanine financing. And as projects like Amu Power are getting larger, the amounts required to finance these projects are growing. Clearly, this massive reliance on DFI money needs to end at some point. The question is, what are the options? Is it local commercial banks? Is it the international commercial banks? Is it Chinese money? Is it Power Africa? What are the options you think that are available for projects beyond the traditional DFI money? And like I said, the DFI funds have been funding senior debt, mezz, and a lot of equity in most of our projects. Again, it'd be interesting to hear from the panel, starting with you, Vahid. What are the options that are available to sub-Saharan Africa, and how do we tap into that market?
Okay, well, I think the tap is on, and hopefully it won't get turned off with the DFIs. And I don't think we should suggest that the tap should be turned off, because there's certainly an incentive for the DFIs to continue these, because they have a mandate to support development, and there are developers who want to support that through their own development resources. So whether it's DFIs or IFIs, I think that from what we see, there's still an appetite. And frankly, when we go to the market, we find several options in terms of both at the DFI level and at the IFI level, who are willing to finance our projects. So the funding is there, and that's very encouraging. Beyond that, we're seeing the international commercial banks enter the scene as they're becoming more comfortable with the risk profile of these renewable energy projects. So I think next is, of course, is the international banks, and they will start playing a role. Still, domestic banks, personally, I don't see it. I think that personally, the local banks still don't have a full grasp on it, and interest rates are quite high. Their access to US dollars is limited, and the interest rates that they require would kill the project and the tariff as it stands today. So I'm kind of bearish on domestic banks. With regards to Power Africa, I think Power Africa is a great umbrella program. It has many channels and offers many different opportunities. Even at the very early stage, if you want to develop the project, I know developers in Kenya, for example, some of whom have been granted almost $1 million just to cover their development expenses, which is fantastic because then that lowers your cost of financing. So Power Africa, I think, is a great tool, but like an encyclopedia, you have to know where to look. And if you know where to look, you'll find great insight and great resources. As for Chinese financing, whether it's ECA type XM financing, I think it's a great concept, but in reality, we don't see much of it happening. And otherwise, most of the financing is done through a G2G level, government to government level. Unless you're privy to that, you're not going to get any of it. So I think DFIs are still name of the game, followed by the international banks, and then followed by the Power Africa concessional funding.
Thank you. Osman?
Well, I think DFIs and foreign capital, generally, when a country's trying to attract that to build its infrastructure, then you know there's something wrong, right, with that country, in the sense that why is that country not able to build essential infrastructure with the capital that's inside the country already? And if you look at the case studies of Asian countries, Indonesia, Bangladesh, Pakistan come to mind, who had successful IPP programs in the 90s and even 2000s, and it all started with foreign investors, DFIs lending, and then eventually the local money, industrialists, investors realized, oh, there's money to be made. And so now a lot of the IPPs in these countries, or most of them, are being developed by local money, using money that they've kept abroad, bringing it back, and also borrowing from local banks. But when I look at Africa, and what happened in Nigeria with the privatizations, where most of the distribution companies went to local investors, that's very, very heartening. Now, of course, they have a challenge over the next 5 or 4 years to fix those distribution companies, and then to also build generation companies. Now, what would be really bad is if these local investors now turn around and sell everything to foreign investors, flip them to foreign investors for a short-term gain, and then you again have the problem of foreign investors coming in, needing to make a return in US dollars of 20% or what have you, and then that will again, you will have an outflow of capital rather than inflow. And to answer your question in one word, the real alternative to DFIs is local capital investing, borrowing money from local banks. But before that can happen, of course, the local banking sector has to be fixed and improved.
Thank you. Nicholas?
I think actually what you have to do is to keep in mind the framework. Why are we developing these energy projects and why do we want to construct them? The projects are being developed because there is a need for power, there's a demand. So the market needs power. And what's quite typical about the energy sector is that when you go to a bank for money, whether a mortgage or large funding, you don't expect them just to say, yes, we have money, we're a bank, we have money, so we'll lend it to you. When you flick on a switch in any room, you expect the light to go on. So it's a different type of commodity, let's say. Energy needs to be there, and it's used to develop a country. So if the country develops, it needs more energy, and it's kind of a circle. And at the end of the day, you'll have a well-developed country with a strong banking sector, with local equity or let's say, regional equity available. I think that's what you have to keep in mind, that the development of energy projects in sub-Saharan Africa, but in any country basically, is to make sure that the rest of the economy can come to, can flourish. Energy is at the base of that. And so that in turn creates wealth, and that wealth builds power plants.
Francis, I guess Gulf Energy in many respects has done things differently. You've relied on local equity for your HFO project, for the coal project. You've looked to commercial banks like Standard Bank. And so where do you see the source of funding coming from beyond the DFI club? I agree with Vahid. There's still an important source of financing for projects, but as these projects get bigger, as country limits are reached, as project limits are reached, I think we definitely need to do, frankly, what Gulf Energy has been doing is tapping into the local markets and tapping into different markets for both debt and equity. What is your advice on this?
I think there's room for everybody. Obviously, as the projects become bigger, then the universe of lenders starts to get less and less, because typically all lenders want to take the mandate and then start to shop the deal around. But for our core project, it's an ECA-led type of debt, so it becomes a bit easy if most of the export package is coming from one country, and if that country has a strong banking system or commercial banking system, then they'll always follow the ECA framework, makes it easy. One of the things that you see depends on also the cycle and the experience of the developers. You find that a lot of developers want to work with the DFIs in the first few projects, because DFIs are very, very good at helping deepen the technical capability of developers. But DFIs are also painful to work with. But over time, then the developers know what to do, and they're able then to go and develop this and practically hand over a deal that is fairly well cooked to the lenders. By the time you're going to the commercial lenders who do not have the patience of the DFIs, then you have a transaction that works. So really, to any developer there, you have to look at yourself and see where you fit in that space. Regarding the commercial banks, they have the challenge of size. The deals are big, so their balance sheets are not able to handle the kind of transactions that you're talking about. The tenors also that they are able to give for the debt are fairly short, and that basically doesn't meet the tariff aspirations that most of the developers would like to have, or the off-takers. So I think it's going to be a space that is still going to remain close to the local commercial banks because of that, and also the lack of access to low-cost, hard currency funds. But what is interesting now is on the equity side, a number of countries are trying to mobilize their pension funds in a manner that basically creates pockets of capital that have scale. And the interesting part of it is where developers will be able to package projects, de-risk them in a manner that they're able to then become attractive to the pension funds, because then you have actually a very good source of equity that can keep projects running. And pension funds are interesting because being local, the whole element of political risk starts to disappear. And you find that governments are very careful around pension funds because they can't go around messing around with the future of their people, as opposed to individual investors where when the going gets a bit tough, you may find that governments want to start to push around private investors. So in a nutshell, I think there's space for everybody, but it's for the developers of projects to look at really who to target for the different types of projects.
Excellent, thank you. I think with that, I'll open the floor to the audience. If there are any burning questions out there, I can see a hand up at the back.
Thank you. I'm Florival Mukav from Mozambique. I come from a country with huge potential in terms of energy production, in a region with acute needs for energy. As example, you have countries like South Africa and Botswana that are literally in dire straits. The economies have been seriously impacted by the lack of energy of late. The question is that in the absence of DFIs that are willing to assist the governments in providing government guarantees, because in a country like Mozambique, you'll need the nuance of the World Bank to provide the government guarantees, and you won't get that. So the developer comes to Mozambique, the potential is there, the South African market needs energy, but you can't couple these needs with the funds that are necessary to develop the energy. Are there any venture capital companies or funds that would be willing to risk and tap into those markets? Or any other solutions that you would present to us? Thank you.
Anybody want to take that up? Nicholas, go ahead.
I think actually what you should try and do is what I said before, is the mechanism that you're going to build to get power, whether through an auction process or whatever, that power is actually in the end sold to a consumer. Now, as a government, you can choose to subsidize, which you probably will, because, for example, renewable power might be more expensive than what you as a government want consumers to pay, but you actually only have to cover that delta. What you need to make sure of is that the investor, whether on the financing institution, whether on the debt side or the equity side, he needs to know where that money comes from. And everyone says we need government guarantees. Why? Because that's clear-cut and simple. And as you say, the government itself, it's written on it, it's added to its debt. And because IFC funds the project on one side and the World Bank funds the project on the other side, and they make money on both sides, they fill that circle and they solve it like that. But in essence, you need to be able to, lenders want to know where the money is going to come from. And that's how you need to think about this, rather than who is going to back me. It's a very difficult problem, but that will be the only way to really solve it. Because if you ask someone else to take the risk, he's going to require a return on it. And if you, let's say, bank it as a government fully, it's going to be added to your debt. So it's a vicious circle. You can't solve it except if you can really show where the money is going to come from. And in essence, that's from your economy. That's from the consumers.
Any other question? Gentleman in the front.
I want to know the opportunity that is available in Africa for mini hydro plants.
For mini hydro? Yes.
They are downriver plants that use the water and supply power. We can bring our own funding, but we would like the power to be by the local government or the municipalities or the government, so that we get paid for the power we supply. So it's the opportunity available.
Gentlemen, any mini hydro experts over here?
The answer is quite simple. The opportunities for hydro in sub-Saharan Africa are enormous. That answers the question, but
the problem is the same.
But the problem is the same.
How do you get paid?
Yeah. We're actually, we're looking at hydro in DRC, and there it's quite interesting. you can actually build your own distribution grid and you can start your own supply to consumers. So they're basically saying you can do it all, just do it. The problem is that it's already difficult to have a bankable generation project. If you're doing the whole value chain, it's even more difficult. But if you can do it, then you've solved the question, basically.
They're all trying right now to do it. Wind, solar, coal, and I guess the issues are the same, irrespective of your technology.
I mean, let me try and answer that. In Kenya, I'm familiar with the framework. There is a feed-in tariff that actually clearly provides for a structure for the mini hydros. And the country, I think, there was a study that's saying there's a few thousand megawatts of potential. So the framework exists. And one off-taker, which is fantastic because then it's the same off-taker that all of us are taking a view on. So there is a structure that exists in Kenya. The challenge is projects of scale, because you are going to go down there and set up and start to develop the projects. Now, Kenya is not doesn't have big hydro prospects, so you're going to have to really look at your economics properly when you're trying to develop small projects, a few megawatts at a time. Deal with the communities, get all your project agreements lined up and all that stuff, and see that it actually works for you.
Thank you for that. Unfortunately, I've been told that time is up. Sorry for that, but you know, these gentlemen are here hopefully till tomorrow, so feel free to grab hold of them and, you know, get some answers and hear some of their wonderful war stories. But in the end, it's a pleasure, notwithstanding the difficulties in doing these projects. It's an incredible pleasure when you get to that point of financial close, when you get to that point of commercial operation, especially in sub-Saharan Africa, because these projects really matter. And I hope we all continue with the battle, and hopefully next year we will have even more success stories to talk about and even more opportunities to discuss. Thank you very much.